Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are joining us as we talk about financial matters. Both myself and the co-host here, we're both financial advisors, certified financial planner, chartered financial consultant. Just means that we kind of know what we're doing here.
We think.
I hope we know. Well, yes, we think we know what we're doing, and we think we can provide valuable information to you. So we meet with people like yourself during the week and come broadcast on the weekends to be your financial advisors on the air. And we are glad to be doing this program.
And we like taking your calls. That's just the reality of it.
We tried years ago without calls.
Yeah.
Because some producer guy said, some guy from Clear Channel or whatever the company was at the time, it said, oh, these studies show that you're better off not taking calls. And we tried that?
Yeah, for about 2 weeks.
Yeah.
I hated it.
I know.
I like that interaction.
Well, what's fun about it is oftentimes the question somebody has is really, it's not directed to the true problem at hand. There's another issue, a bigger issue oftentimes.
Or they start with a product as the solution.
Well, that's always a bad idea.
Yeah. I had that yesterday. An existing client of mine asked if their son could talk to me about a living trust. And so
Their son?
Yeah, an existing client.
Okay. How old was the son?
Probably 35.
Okay.
And it came to mind, a longtime client's husband dies, wife helping to clean up the estate, which, by the way, was easy because we had done the work previously. Very, very easy. And she said, this has made my son think that he needs a living trust because I have a living trust. And I got on the phone with him and said, you don't actually really need a living trust. You have no children. It's you and your wife. What you need is some term life insurance.
You have no assets, yeah.
Well, he had some assets. Nice kid. Anyway, but
and your point was?
My point is that that interaction, and he started with he thought a product would fix his.
Well, I tell you, I was reading an article this week about the cubes have made a comeback.
Oh my!
QQQ, the ETF QQQ, which we've been doing this long enough through enough market cycles. It was in the late '90s when ETFs, which are just kind of another form of mutual funds, came out. The index to track the NASDAQ went by symbol QQQ. People call it the cubes. And the NASDAQ was on fire in the latter part of the 90s. 1999, I think it was up 76% or something that year. No, it was 85.
It was
85%. 85% that year. Phenomenal run. And then things fell. NASDAQ came crashing down 70% from peak to bottom, and it languished for years before it hit a new high, but it's on fire again. And I'm reading this article, and it's talking about these younger people are investing is what they call it, investing in it. The profile on this guy is 23, learned about it on Reddit.
Of course.
So they learned about it on Reddit and thought it was good. He saw how much it had gone up and the companies that it's in, so he thought it was a good idea to be investing. So he's putting in $100 a month into this. And I thought, it's not going to end well for him.
Well, better at 23 than 63.
When you put your life savings in something like that. 100% better.
Yes. Better to learn early. It's there are market cycles.
Not to say that the cubes won't be higher 10 years from now. They're just going to go through a lot of cycles between here and there.
It doesn't mean that they're going to be...
doesn't mean it's going to be a good return either.
Doesn't mean it's going to be better than the S&P 500 or the total market.
It may not be positive in the next decade. It's impossible
Scott,
to know.
This week, I watched on Netflix, The Last Blockbuster. Have you seen this movie called The Last?
I thought you were going to say The Last Documentary, because you've watched most of the documentaries.
I thought
it's the last we're out. They say we can't recommend it anymore to you, Mr. McClain, because there's no more documentaries.
You can find some obscure documentaries, but it's called Blockbuster, The Last Blockbuster. And I'm watching this and I'm thinking, this is a perfect example why you should not own an individual stock in a portfolio and pretend like it's going to do well forever. Because this company went from, and by the way, back in the day, it was revolutionary on how they actually priced videos for rent versus the competition. Right? Just
Blockbuster?
Blockbuster. They did revenue share. Everyone else had to actually go out and buy $80, $90 for a VHS tape, and the suppliers would only sell you
I wonder
three.
what percentage of the profit came from late fees? All of it?
Quite a bit of it. Quite a bit of it. Actually, so anyway, they went from 9,000 stores down to 1. This is the last Blockbuster. But they put, in the process of growing to 9,000 stores, they put hundreds and hundreds and hundreds of small stores out of business, and then themselves actually folded after being approached by Netflix wanting to sell themselves to Blockbuster. Blockbuster just said, no way, never going to happen. But just, anyway.
Things change. So what's the next thing that's going to disrupt the hot things today?
Yeah, what's going to
I
displace?
don't know.
Is it Tesla? People believe it's Tesla. I don't believe it's going to be Tesla, quite frankly. I think it's probably going to be Volkswagen that displaces Tesla. That's my belief. What's going to disrupt everything else?
There's so much momentum investing right now. Netflix has been on fire. You want to talk about a company that's really pivoted, and they've done an amazing job. They started out with mail-ordered videos, essentially.
Yeah, it is a direct competitor to Blockbuster, who was doing mail order as well.
And Blockbuster almost bought them and decided against it.
That's right. And then just
they would have. I don't think Netflix would not. They probably wouldn't have survived either. It probably would have.
Well, actually, what took Blockbuster out is debt. Debt. Remember that. Not only in corporations, but individuals, debt. That's what took Blockbuster out. The competitive environment, and they couldn't service their debt, which takes people out all the time. Individuals, companies, homeowners. Hey, what do you think about this $1 billion forgiveness of student loans?
Which one?
The one that this last week that they've...
There's
President Biden. I
wonder where's all the money come from?
Oh,
that's the
the
government doesn't have money. They don't make products and sell services.
Well, you know where it comes from. It comes from debt right now, but it won't be debt for always. It'll be taxes to pay the debt.
Well, I have a real problem with guaranteed federalized student loans to anybody and everybody, regardless of what the purpose is. That's plain and
this $1 billion was for those that were defrauded because they didn't get the right degrees and they were.
I must not have seen this story.
And anyway,
because there's what, $1.5 trillion in student debt.
Yeah, it's not that big of a number in relative terms. But I was thinking, the government created the fraud by lending money to people to go to these crappy schools.
That's right.
Right? So shouldn't the government be somewhat responsible?
He was going to set up a massage school to teach massage therapists. Not that he had any passion in massage. Just thought he'd make a quick buck. It was all based upon the student loans because students get student loans to go to massage school.
Yes, my point exactly.
Federally guaranteed.
Did he set it up?
No, he didn't. It
was a dream.
Sound like my nightmare.
Let's take some calls. What's our phone number? 833-99-WORTH. That's 833-999-6784 if you'd like to join this show.
Numerically, by the way. And you can call anytime. We'll schedule a time. We record the calls in this program during scheduled times. And much the way Judge Judy records several episodes of, what's the program called? Judge
Judy.
Oh, I've never seen it, but she seems like a nice lady. 833-999-6784. 833-999-6784. Give us a call. We'll schedule time for you to be on the program as well. Anyway, right now,
She retired, by the way.
She did?
Yeah, she retired. Quite the little empire, too. She had like 3 or 4 shows. Hot Bench, a couple other ones.
Hot Bench was the title. That's a funny title.
Hot Bench, where they actually had 3 judges that adjudicated.
Oh, look at that.
Actually, I know a little bit
You're watching too much TV.
No. I read an article about her.
All right, let's go to calls now. We're talking with Andrew. Andrew, you're with Allworth's Money Matters.
Hey, great. Thank you. Thanks for having me.
Yeah.
So I've got a question about, I recently acquired a rental home through family as a family home. And it's got
You acquired it through a family?
Did you inherit it?
No, we purchased it.
Okay.
Kind of at a quote family price. So, so we're ahead on it. We've got a renter in it now, and it's generating, a couple $100 a month of positive cash. So my question is, then I have a home that I've owned for 15 years, and I want to turn that into a rental. But I'm wondering about, should I be looking at paying down mortgages in retirement? I guess that's my question.
So you asked us two different questions, and let's address them. Let's address the first one about converting a primary residence into a rental, because that's probably the biggest question. It has to do with the taxation of the property when it is sold. Okay. So what'd you pay for this house?
For the one that I'm in currently?
Yes, your primary residence.
I paid $308 back in 2005.
And what's it worth today?
5.
Okay. So do you want to address this, Scott, or would you like
Yeah.
me to?
So right now you've got roughly $200,000 of capital gain in this, right?
Okay.
When you go to sell it. It's sometime.
Yeah.
I imagine it's sometime in your lifetime you will sell this house. Right? Mm-hmm. If you sell it shortly after you move out of it, you can exclude up to $250,000 of gain because it was your primary residence. If you convert this house to a rental, you'll lose that ability in the future to exclude $250,000 if you're single, $500,000 if you're married. You exclude that. So even if we thought it was the best idea to have another rental, a $500,000 rental, I would argue, Pat would argue, sell your house and buy the one next door or whatever similar kind of property, just so you can lock in that favorable tax treatment that you'll lose otherwise.
Yeah. And the second thing to think about is, would it make a good rental? Right? So we see this all the time with people who are like, oh, I'm going to take my primary residence and convert it to a rental. Oftentimes, they're the wrong houses. They're
swimming pool,
big yard, wrong location. Older.
Let's back up. How old are you, Andrew?
48.
And are you married or single?
Married, yeah.
Kids?
3 kids.
Ages?
One is 19, one's 17, and one is 5.
Wow.
Ooh. Yeah. Time for another one then. Here we go. Let's just look at the spread.
Exactly, right. Yeah.
And what's your ballpark family income?
Per year, 140.
So you aren't receiving the full tax deductibility, the tax benefits of the rental, I would assume, because it starts to phase out depending on what your adjusted gross income is. So you're kind of right at that bubble. When your income goes too high, I shouldn't say too high. When it goes up, you lose the ability to. They're not lost forever. You just can't claim any of those losses in current years.
And how much debt do you have?
How much debt?
Yeah.
Your primary residence.
What primary residence? I just refinanced it, so I think it's up at I owe $320.
So you paid $308.
Yeah.
You owe more on it than you paid for the house.
That is correct.
And the rental home, how much do you owe on that?
$230.
And what's the value?
And the value of that is about, I would say, about $370.
And how much money do you have saved for retirement?
$400 in a 401k, and then I have a small pension that'll be a part of that.
And why are you thinking about moving out of your current residence and getting a rental, or turning that into a rental?
Well, I thought it would maybe be a good to have income, an extra stream of income in retirement.
But you owe $320,000 on it. So renting it out, you're probably not going to.
Yeah.
The concern I would have
Yeah.
is what happens when you've got a tenant that's not paying the rent? What happens when the roof needs to be repaired? So just like the one you say you got $200 a month, you probably really have nothing, because when maintenance issues pop up, when you have to repair, replace the air conditioner or whatever, it's going to eat up whatever rent you're receiving, netting right now.
And that was kind of the meat of my question to you both: is it more of a liability going forward than it is a good investment?
Yes,
that's my question.
The answer is yes. Are you happy in the home you're living in, your primary residence? Are you comfortable there?
Yeah.
Okay.
Yeah. It's a good neighborhood. It's not the greatest neighborhood, but yeah, it's a nice.
You should just stay there. Don't convert it. Don't think about moving.
Okay.
And then put together a plan to pay this thing off. So in 15 years, right? So you want to pay this thing off in 15 years. You'll be 63 years of age, and you want to start plowing more money into your retirement plans. But I would not, certainly, you're not in a position with that income and your net worth to actually be converting this into a primary residence.
You would just lever up even more. You'd have even more debt. And that's the thing that, like during the last financial crisis, lots of people's homes were foreclosed upon. Nobody's whose home was paid off, to my knowledge, had a home foreclosed. Who's going to foreclose on them, right?
Yeah.
But it's that debt that, and when things are going fine, but if anything, this last year's taught us that you never know what's coming. And you could have a renter in there that says, I'm not paying, and you can't evict them. You can't do anything about them, and yet you still have to make those mortgage payments.
Yeah. And then supposedly they're going to catch up on those, right? They're going to catch up on them. But the reality is most people may not. It's yet to be seen. You would be taking your financial house and putting it on shaky ground by. So what you want to do is amortize your existing mortgage on your primary residence over 15 years. So you just go to an amortization calculator and figure out what the payments you should be making, and then push more money into your 401k. And I certainly wouldn't be adding any more to the equation.
Okay.
All righty.
Great.
All right.
Thank you so much.
And enjoy the 5-year-old, by the way. Actually.
No, he knows. He's got 2 teenagers.
Yeah, he does.
It's so much more fun.
It is, isn't it?
Okay. It's a lot more fun.
Yeah.
And you're less stressed about the little issues.
Yeah, you're better at it, right?
Yeah, we hope.
Yeah. Well, listen. If a friend told me once that if you knew that it didn't matter so much, you wouldn't have tried so hard as a parent. So
yeah,
that's true.
It's true. It's a lot of fun. Hey, well, thank you so much.
Andrew.
You shed a lot of light on the situation. I really appreciate it.
All right.
Take care.
Glad you called. Again, if you want to join us, a question for us, 833-99-WORTH is the number. By the way, this got me thinking. There's a story in California. It was in Chino, some wherever it was. This couple buys a home with cash. They skipped either cash because they know it was a hot market, so they bought it in cash. Closed before the pandemic, and the person who sold the house never left. They wouldn't move, they can't. It was going to be their residence. This guy won't leave.
There is,
and it's illegal to evict someone right now.
Scott, there's a special place in hell. Can I say hell?
What do you mean? Can you say hell? What the hell? People say that all the time.
There's a special place in hell for that guy that sold his house to them. And
you mean that's just pure wickedness?
Yeah, just evil. It's just
I don't know how else to describe it. I'm taking your money. I'm not leaving the house.
Anyway, a special place in hell for the guy that sells his house to this young family, pays cash, all excited, and he's like, you know what?
They cash out everything, all their investments and stuff.
The rules have changed. I don't have to leave. I'm just going to stay here.
And there's no back rent. I don't know. I mean, that's a bizarre thing.
I was hoping you were actually, when you said you read that article, I was thinking the same thing.
I thought that's unintended consequences of laws. All right, let's talk here with Steve. Steve, you're with Allworth's Money Matters.
Hi, Scott and Pat.
Hi.
When I retire in the next year or so, I should have about $750K in my 401K. And I'd like to take about $100,000 or $200,000 and put it in a home improvement vacation fund. But with the remaining money, I need about $2,400 a month additional income to supplement my pension. Is that doable?
So, first of all, taking the money out.
Well, when you say taking the money out for home improvements, you mean cashing out the 401k, paying taxes on it, and then doing the home improvements. Is that what you're saying?
Well, I'd rather convert it and not pay the taxes up front and just have that money sitting in an account that I can access it easily.
So you're not going to recognize the gain. In your mind, you're splitting the IRA up, one to provide income or the 401k up, and another part that you can draw on for supplementary expenses.
Correct. So I'd have about $550,000 that I would somehow need to get net $2,000 a month.
Yeah, I don't think that's a 4.3% distribution rate. I don't think that's unrealistic, depending upon how the portfolio is invested. You have a pension as well, right?
A very small pension, yeah. But I've gone over all of our finances, and this is what I've come up with. I would like to supplement about $2,000 a month net.
How old are you?
58.
And when do you retire?
Well, I was going to wait till I was 59 and a half, so I don't have to suffer the 10% early
And
withdrawal.
how much is your 401k balance today?
$760.
Okay. I was just concerned that you were expecting it to continue to grow another year.
And have you
No.
have you factored Social Security benefits into this?
I have.
Your income?
I have. Yes, I have.
I mean, so if you were 68 with a larger pension, I'd be much more comfortable. 4.3% sounds like a low distribution rate, but the challenge, we're in a very low interest rate environment right now. I'm confident that over the long term, you can do that and have it grow with inflation. But in order to do that, you have to have the portfolio has to be invested with some stocks in it. It's going to be volatile, and you're going to have to be comfortable living with that.
And are you going to lower your monthly distribution once Social Security kicks in, or are you going to keep it the same?
I'd like to keep it the same. I don't actually need $2,000 a month, but in order to sustain the lifestyle we're used to and maybe have some extras.
What do you owe on your house?
$220.
And with the repairs you planning on doing to the house, the challenge is taking $100,000 or $200,000 out of the 401k is all going to be taxed as income. So you might end up losing 40% of that, depending on how much you take out in any one year. I think you could probably accomplish the things you want to accomplish.
It's tight, though.
It's a little tight. I mean, if you worked a few more years, here's what I would highly recommend: have a financial advisor that specializes in retirement planning. Create some plan, not someone who's selling product, by the way, because guys who sell annuities and stuff.
I have my 401k is through Fidelity, so I have been speaking with.
Yeah, but they're not
Fidelity.
They're just talking about investments. What you want to do is what if scenarios.
Planning all this out, right? When Social Security kicks in, what's that going to look like? Like maybe you take a little more from your 401k between now and the time Social Security kicks in, and then lower it back down. Like, so you can do a lot of different what if scenarios. What if you left today? What if you worked for another 4 years? And you can map all that out so you can make an informed decision. I would approach it from that angle first, and then back into these other
because the scenario you laid out is possible, but it is tight.
It's not. It would be a horrible idea to take $200,000 out of your 401k in 1 year to do house. It would be the worst way to pay for it because of the tax consequences.
Well, I don't really have any home improvement. I was just calling it a home improvement / vacation fund that I would like to set aside.
So you don't have it earmarked for anything?
No.
Oh,
No,
I feel much more comfortable about that.
If I were to walk into your office today and give you this scenario, would you be able to sit down with me and on paper show me how I would have this supplemental income for the rest of my life?
And more so probably using a software program where you can play different scenarios.
Yeah, you sit down
and what happens if you have another financial crisis occurred, and so how would that? And so the idea is to give you the highest probability of success in retirement. Any good financial advisor, any good financial plan is really about probabilities, having the highest degree of probabilities for success in retirement. So that's what as financial advisors, we care about when you're 68 or 78 or 88 and making sure you're in the right place there. So I would strongly recommend going through that financial planning process. I mean, you're like, it would help you, whether you or not you just chose to hire an advisor, I think it would help you immensely just going through this process. All right?
The problem is not many people are having in-office visits right now.
Oh, they can do it remotely. I mean,
Yeah.
we have
And
70 advisors across the U.S. that are doing these meetings remotely.
And that will change probably within weeks. We got to take a quick break. Stick around for more of Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Thanks for being part of our program today. And you are part of our program because it wouldn't, for our listeners, we wouldn't have. It's not like a hobby podcast we do. Although I wonder how many podcasts there are today.
Oh. Like how many kids are living in their basement putting out a podcast?
Yeah, I know.
Trying to be a social influencer. Right.
It's a strange time we live in when you ask the average 16-year-old, what do you want to, girl, what do you want to do? And you want to be a social media influencer. We had a TikTok star last 4th of July.
What do you mean you had a TikTok?
Up in Tahoe.
What makes you a star?
He was, I don't know how many followers he had. He was making a lot of money. He was a college kid. And we were up on Tahoe with a boat. It was 4th of July. And
was he doing TikTok videos while you were on the boat?
No, but he seemed like he was performing a bit. Actually, he was a very animated kid. And it was my friend it was my friend's son's friend, a college roommate or something like that. And apparently, and he's like, oh yeah, he's already been found out that he's in Tahoe because one of his pictures, and there was like girls all knew who he was. And
were they stalking you?
No,
like they were.
We're in the boat in Tahoe, so no one could stalk us. But it's just the strangest thing, and it's just this. That whole fame thing is such a bizarre thing. I don't understand it.
Well, I have 10 million views on YouTube on my.
The bear one?
Yeah, the bear one.
Yeah.
But it doesn't make me famous. You can't see my face. I didn't film
Pat
it.
Came face to face with a bear, and both the bear and Pat turned the direction, went running.
And someone filmed it and put it up on YouTube, and
you don't get any credit. Where's the royalties?
I get nothing out of. You can't see my face. It's blocked by an American flag. Very patriotic, by the way.
Is it a Trump flag?
No. No, it's an American flag.
Okay. All right, let's go. I don't know why we got sidetracked on that. How did we get sidetracked on that?
I don't know, but let's get.
It's a bizarre.
Like people wanted to when we were young. You wanted to be like a doctor or a lawyer or.
Now you want to be a. I've never even been on TikTok.
An influencer.
I'm on Instagram just so I follow my 2 children, older children.
Do they use it a lot?
My son never, almost never. My daughter, my 25-year-old, she posts. If you just followed her Instagram, you'd think for sure she's an alcoholic.
Really?
And then all she does is party. Because it's like she's with a friend and they're out to dinner and she takes a picture of her wine glass, take a picture of her White Claw drinking with their girlfriends. And
That's the look?
It's like you want her life, right? That's how these things are. Like, so they have this.
Yeah.
Not to be an alcoholic. I didn't mean that. It just looked like she's always.
Okay. All right, write that down.
If you other than that part. It's just this. It's this.
My kids
world.
show me TikTok things. Like we'll be sitting at dinner and they'll like, watch this, Dad. But I've never been on TikTok myself.
I have no desire. I'm not on Facebook.
No.
I'm tired of it all. All right, let's go back to calls here. Talking with Charles. Charles, you're with Allworth's Money Matters.
Thank you, gentlemen. Thank you for your integrity and the service you provide.
Well, thank you.
Thank you. Appreciate that.
My wife and I are in our mid-30s, and we're starting to make some more advances in our career and our income, and we're starting to see that taxes are starting to go from just a mild nuisance to a serious chunk of our income. And we're both already maxing out our 403Bs, our company-sponsored 403Bs, and we were hoping to take advantage of some of the relief bills because we both have children that are out of school. We've had to pay for childcare. We're both healthcare workers, and so we've had to go in person. But because of our income, we didn't qualify for any of that. And so we're just wondering: is there anything we can do proactively to help ourselves on the taxes? And I mean,
quit working.
I'm happy, right? Well, I'm happy.
I'm kind of saying that tongue in cheek, but I mean. I think this $1.9 trillion relief package, the wealth transfers, it hit about 75% of Americans. So 25% didn't get any. Of course, we're all going to pay for it. 25% didn't get any, and 75% received
some
or
a lot. Whatever. And
you were the 25%.
Whatever a lot means.
You were part of the 25% that.
So there's nothing really you can do today.
If you're already maximizing, I mean, sometimes when you contribute to a company retirement plan, 401k, 403b, it reduces your adjusted gross income, which is a number that's often looked at when it sees if you qualify for certain benefits.
And you're doing that. The other things that you take advantage of are growing dollars tax deferred or tax free. And that's a completely different issue because what that's going to do is it's long-term tax planning. But in terms of what you can do tomorrow in order to lower your taxes, there's not a lot. There is not a lot. And there, so there's a couple of advisors that are listening to this right now saying, well, you're wrong. You could buy low-income housing tax, so you get some tax credits.
There's limits on that too when your income goes. All that stuff gets phased out.
That's right. That's right.
The problem, I mean, if you look at the studies of where the taxes are coming from, I mean, the top 5% pay the majority of the taxes. I think the top 1% pay about 50% in and of itself. So as your income goes up, you begin to lose your personal exemptions. You lose some of your itemized deductions. You clearly lose some of the, when your kids are at college, you're going to lose the ability to get student loans or grants.
You're in the state of California, so you don't get the state income tax against your federal.
That's the society where that's part of the political discourse that's been going on the last 10 years or 20 years, right?
I hear all this talk on the news that, if you make $150,000, you're wealthy, you don't need it. And my wife and I that's not the case in California. You could be making that money if you're living in a big city and just be living paycheck to paycheck.
That's right. Can't afford to take a cab down the street.
That's right.
New York,
That's right.
You're making that. Right?
The things that you could do for long term is fund the kids' 529 plan, so the dollars grow tax deferred and they come out tax free. When they go to, you can put a non-deductible IRA contribution in and then convert it to a Roth IRA the very next day. Those are long term tax planning techniques to treat your savings. But in terms of what can you do today, there's not a lot.
Well, that's related to my other question.
And you can give to charity, but even that's not wouldn't help you. Giving to charity is an itemized deduction. Page 2 of the tax return, it's your adjusted gross income, which is that at the bottom of your first page. That's the number that typically is used to determine eligibility for a lot of these programs.
Well, our employer just started to offer a 457 plan. Should we be taking advantage of that?
Slow. So you work for a county or state-owned hospital.
Correct.
Okay, so you have a 403B and a 457. I'm going to guess you work for UC Davis. But yes, you can do those both. And we miss that, quite frankly, because it's such an unusual thing.
That's correct.
Is you can maximize both the 403B and the 457, and it will lower your taxable income. You'll have less disposable income.
The balance is like how much at this. Maybe the tax rates actually are low today, right? So
yeah. Well, my wife's worried because it's a non-governmental, and so she's worried if a company goes bankrupt, which I think is unlikely, that it wouldn't be insured.
That's correct.
Wait! I missed that. It's non-governmental. What are you talking about?
Well, and the 457 is relatively new. We work for a charity. It's not a government hospital.
Got it. Yeah.
So
Yeah, see, with 401ks, 403bs, they are separate accounts that are not assets or liabilities of the employer. A 457 or sometimes a non-qualified deferred compensation plan that companies have, those are assets that are subject to creditors of that organization.
They are an asset of the organization, not of yours.
And if the organization goes bust, you are a creditor just like everybody else, and you stand in line to see what portion of your dollars you get back.
How big is this nonprofit?
really big. It's one of the largest on the West Coast.
Okay,
yeah.
and it's been around a while.
Correct.
Okay, yeah, I'd be okay with the 457. We've actually never seen any, technically. And by the way, it's pretty impressive that your wife actually knew that the 457 was an asset of the organization.
The accountant.
Okay.
She's the accountant in the family. She does the taxes and takes care of a lot of this.
But here's the challenge. What's your family income right now? Your gross family income?
It's about $240, but we're finishing up some training and licenses and about to get a promotion, so we're thinking it's going to be above $300 in the next 2 to 3 years.
I'd fund the 403B and the 457. Absolutely.
You're so young. You have so many years. Who knows what's going to happen in the future tax? But I wouldn't do that exclusively, though, Pat. I'd use some Roth for a portion of it.
That's right.
I'd have some of it as a Roth portion, so it goes in after tax, because we don't know what the future is going to be. What happens if the tax rates when you go to retire are higher than they are today?
Then it was for naught.
As high as they might seem, it could be worse. And you're if you were in your mid 50s, it'd be easier, but you're a long way off.
But I would absolutely consider both funding the 403B to the maximum and using the 457 for some,
or using a Roth portion of one of those. For 25 to 30% or something.
And one last question, if you have time, please. We have a CD that's getting ready to come into completion. It's $20,000. It's basically just cash we set aside for our children's education. We also have a 529 plan, and the more I learn about it, the more I think we should be taking more advantage of that.
Yes,
agreed.
But I've also been reading a lot of material from Dave Ramsey, who said, and listening to his program saying, because we do still have, the only debt we have is our mortgage and we have a rental. And he's really big on just paying down debts, right as fast as possible rather than necessarily putting more.
How many of his listeners, I have tremendous respect for Dave Ramsey and for the organization he's built and for the advice that he provides. I don't agree with it 100% of the time, but it's fine. But most of the people who follow his program are not professionals making family income of $240, going to be pushing to $300.
And how old are you?
Mid-30s.
34.
Oh, I wouldn't be in any rush. I wouldn't be in any rush. I'd fund the 529.
If you're in your 50s, I think debt can be I don't have a mortgage on my house. I used to. I don't now. I'm 54. I just don't have a desire to have a mortgage on my house. But when I was in my 30s, I did, and
even in your 40s.
Even in my 40s, I did.
Yeah, I wouldn't be in a hurry to pay down that mortgage. I would fund the 529 plan first.
Okay.
Right, and then I'd fund the 457 before I started accelerating on that mortgage at your age and at your income level.
And I tell my wife she should go part-time. That's my only other thing.
Does she want to?
In a way, yes. Yeah, she would, but just in our profession, it's kind of hard to find a part-time. Everybody, in fact, it's the opposite. The more you want to work, the more they, in the medical field, you can work as much as you want.
Yeah.
Yes.
But that's maybe the goal. It's almost a disincentive to work extra. When you get hit so hard. But.
There's always net income, but what right there, that is the perfect explanation of why when tax levels go too high, it's a disincentive.
Right. He's like
the poster child for it.
If my wife was part-time, I'd probably get all these benefits. I get the stimulus check. I get maybe the tax credits that are getting doled out.
Yeah.
We'd have a different lifestyle, but I'm okay with that. That's how capital actually works, right? The higher the tax levels on earnings, wages, and capital, the less incentive one has in order to perform that function to make the money. It's reality.
Well, of course. What if the tax was 100%?
That's right. What if it was 80?
At some point in time,
You're just like, I'm not going to take the risk anymore.
right. What's the point?
Yeah. So,
But the interesting thing, I mean, what you're balancing here is like what are your priorities, right? Like, and her career might be a really high priority to her. Maybe it's not as a high of a priority and working part-time. And then that means you don't have as much finances, but maybe that's fine as well.
that's the trade-off.
Maybe you push retirement out a few more years, but maybe that's fine as well. Money's just one piece of it all.
Yeah. And the kids are young.
Right.
Yeah. I mean, if the kids were 20 and they were living at home, you'd all be wanting to work full-time.
Well, I can understand when the kids aren't in school why you want to go to work.
Appreciate the call.
Yeah, it's been a bizarre time for everybody. All right, let's continue on here and talk with Dean. Dean, you're with Allworth's Money Matters.
Hello. Thank you for taking my call. I'm looking at Social Security. I'm 64 and a half. My wife is turning 62, and we're just wondering, should she take Social Security now at 62, or should she wait until I retire so she can, get a higher benefit? Obviously, if she takes it now, it would be at a reduced benefit.
Yes, quite significantly reduced benefit. And you're still working.
Yes, sir.
When do you plan on retiring?
No time soon. Probably at least 2 to 3 years down the road.
And what's your income?
My income or total income?
Your income.
Approximately 75,000.
And what's your wife's income?
She does not work.
And you have income from other sources, pension or investment income, or just what you answered?
Well, part of my income, I'm taking a disbursement from my 401k.
How much are you taking?
30.
And how big is your 401k?
It's around 850,000.
So about a
so first of all, the way to get the answer to your question is to run some different scenarios using your actual numbers, because there's calculators out there that can do that. But
sure.
Right. And if she's began today, I would say whatever she receives, you should reduce your 401k by that amount. But my gut, without knowing the exact numbers, would be that it's going to be best for her to wait.
Do you have any debt? Do you owe any money on your home?
I've got a $20,000 mortgage. That's it.
No, that's pretty much no.
Which could be I could.
Are you living
Are
you living comfortably on this $75,000 a year?
Yes, sir.
Okay, so I agree with Scott. As long as you reduced, she could start today, and as long as you reduce the distributions from your 401k.
Well, we don't know if that's the
amount.
right thing unless you got to go through and run the numbers.
Well, actually, Scott, there's on our website right now, Dean, there is what we call retirement factoids, and there are 81 ways for a couple to claim Social Security. 81 ways. So Scott's point is well taken, which is I could give you one or two of those ways, but the show's only an hour. I don't have enough time to go over all 81 ways. But on first glance,
it depends on what her like. If her benefit's going to be greater than 50% of yours, maybe it makes sense for her to take it right away. If her benefit's very small, well, you wouldn't want to take the reduction and have that.
And how's your health and her health? That is she in good health, great health?
She's in good health. I'm in great health.
Okay. One of the things that if you have a less than normal life expectancy or expect to have a less than normal life expectancy, you want to take it early. But this situation, no, I don't. You got to do some planning here.
Yeah, it goes with more planning than just giving you. My gut would tell me to wait, but
I I would say the same.
And particularly if you waited till you
Right.
retired, and then it'd be just more income that you would be replacing of your salary that you're making today.
Well, obviously the Social Security goes up 8% every year, and you wait.
That's right.
Yeah.
It's guaranteed.
But you're taking money from your 401k, which is the offset to that.
Correct.
If you weren't taking the $30,000 from the 401k, I might feel differently about it.
But that, which is about 4% of what the what the 401k is.
Yeah, my guess is going to be that you're going to want to wait on it, but I would
Sure.
If it were me, I'd run through the calculations. If you were a client of the firm, we'd run through the calculations, and then you could make an informed decision. That's what we would recommend is to actually go through the numbers. I think it would be helpful for you to see.
Visit our website, 81 Ways for a Couple to Claim Social Security at allworthfinancial.com.
Yeah, and actually, we have a couple factoids right now that we're highlighting, and the other one is. This sounds very self-serving, but working with a good financial advisor is worth about 3% overall return. And that's a study from both Vanguard did a study, as well as Morningstar. They both did studies, and it highlights. It doesn't mean you're going to get 3% a year more in your portfolio, but it highlights the various ways that a good advisor can add value. And while it could add up to that much in what it really means to your overall net worth over a long period.
The key there is good advisor.
Yes, a good advisor.
Good advisor.
Yeah. All right, let's continue on with calls here. We're going to talk with Bruce in Minnesota. Bruce, you're with Allworth Money Matters.
Hi, thanks for taking my call.
Yeah.
Yeah, so I know you talk about diversification and investing like no more than 5% in gold, that type of thing. And I heard last week on your show, I listened to it on the way to work, that in the comments they were talking about gold, and you can't really take a bar of gold into a store and use it. So I've discovered and wanted your opinion on this. A company called Glint Pay or Glint, and it's based out of the UK. And the concept is you load up a prepaid. Well, it's not prepaid, but it's linked with MasterCard. It's a debit card, a MasterCard debit card. And they have a bank here in the States. They just launched it a couple of years ago here in the States. So they have a bank in Sutton that you transfer money into that bank, which loads money onto this debit card. And there's two sections on the debit card. There's a currency section, and there's a gold section. So that you can transfer whatever money you want into gold. And it's the gold is then bought and physically placed in a vault in Switzerland.
Okay.
It's backed by Lloyd's of London.
Okay.
And so then you can use that and spend it like you would any other debit card.
Okay.
So I've used it for buying a cup of coffee. We went to a hotel or a resort, used it for that. And so with 4 grams of gold, and you're loading up grams.
Okay.
So just wondered if you'd heard of that and what you think
Had not heard of it.
Okay.
I got a little more concerned when you threw in the Lloyds of London.
Yeah.
But
Sure.
How much money
and
did
the
you
Swiss bank.
How much did you put in this?
You know, I'm extremely conservative
Okay,
in
thank you.
The way I invest in that, and so I've only got like $500-600 in it right now.
Okay. I don't understand the play here though. So you get short-term exposure to gold prices? Why not just buy options on gold?
Or
You
an
could, but then
ETF.
how do you spend it? I guess the idea behind it is that it's your money is not backed in a bank. Your money is backed by fiat currency.
Yeah.
But your money here is backed by the gold that you.
But you've
have.
got to transfer it into a fiat currency to use it.
And you're not really making a play on gold because it's such a short amount of time. And whether the gold exists or doesn't exist, we don't know. All I can tell you is that I'm sure the transactional cost in this conversion from currency to gold at $500 a whack is so high.
There isn't any transaction fees.
Oh, there's
if you
transaction
transfer.
fees.
No, I've been doing it since September.
Okay.
So
You didn't see the
there isn't any
transaction
transaction fees if I when I transfer the money. And you can top it up with a debit card as well if you want. But there is a fee once I put it into the gold section.
Okay.
There's a 0.5% fee.
Okay.
And
at what price
later on,
do you
they
pay?
say they've waived it, but later on there will be a 0.125% storage and insurance
Okay.
for the gold.
All right. Well,
If I were to own
have-
gold, I would just buy an ETF.
I know, but have fun. I mean, it sounds like a lot of work, but have fun. I've never heard of it.
It's not really a lot of work, but it's. I guess his idea is here you're going to be backed by gold instead of fiat currency. Yeah.
All right.
The money, if you leave it in your money, then that's just like having it in the bank.
Yep.
But you don't get any interest. So your account does go up and down depending on what the gold is doing.
Sure.
Yeah.
But another way to do that is in a brokerage account. You can just say,
Okay.
I'd like to have an ETF that
Gold.
owns gold, and you buy
Yep.
that and you own it there. Just like you can, and then you can convert it back to cash if you need
And
to.
you could get a checkbook issued with your
Or a
brokerage
debit
account
card
or a
if you
debit
wanted.
card, and you can do the same thing. And you
Okay,
can
so
go
it's
into
the
your
same-
account
it's
every
the same
day
thing.
and move the money
Yeah.
around, and it'd be less expensive than the 0.5 because
Okay.
most of these accounts
I don't
charge
understand the
any.
play here.
I don't understand. It sounds like an awful lot of work to me.
Yeah, not really.
Okay.
Because when you top it up with your debit card, it's instantaneous.
And do you
When you
do you actually
transfer
use
the
this
money-
debit card, Bruce? Just out of curiosity, like go to the restaurant.
I think you'd get a higher return by getting either a Marriott or a Southwest card or something like that.
The points.
Getting the points.
I don't know. At least when gold prices are up and you're out to dinner, you can feel good about it and like, hey, look, we could get this. It's cheaper. And when gold prices are down, you're like, we better don't bring the reserve wine list. Give me the cheapest house wine you've got.
I'm buying dinner with gold tonight.
Anyway, hey, Bruce, appreciate the call. Unfortunately, we are out of time. We broadcast each weekend on the station. And if you're a podcast listener, you can listen to us, of course, anytime. And if you enjoy this podcast, forward it to a friend. Go ahead and give us a rating on your podcast subscription sites. This has been Scott Hansen and Pat McLean of Allworth Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.